The Reserve Bank of India has finally issued the much-awaited circular on restructuring COVID-impacted corporate loans, and the man who has drafted the parameters on which this restructuring should be done is with me, Mr. KV Kamath, who is chairman of that committee. Mr. Kamath, thank you very much indeed for joining us, and many congratulations for doing such an elaborate job in such a short time. It's only a veteran banker who could have done that. I want to start with that quadrant you presented. I think that is the richest quadrant I have seen in terms of the impact of COVID. But its a takeaway is a little alarming. 72% of all corporate loans or all loans are impacted by COVID, you're saying?
Latha, thank you for having me. I think firstly I have to thank my team members and the Reserve Bank for giving us the boundary conditions very clearly, which facilitated our work greatly. Coming to the quadrant and the outline of structure, as I see it, it is not so alarming since I take a different view. It's probably the glass half full or the glass half empty.
Okay.
If you look at it, the last quarter or the quarter before that were the two most impactful quarters, and we had GDP down by 25%. To me, it was not a surprise. And the numbers that we see in terms of the impact, the quadrants that you're talking of, are consistent with that sort of drop, because virtually all of India was shut, and virtually all of manufacturing was shut, except towards, I would say, the month of June, when slowly things started looking up. So I think this was probably the worst impact that we had because of the lockdown, reflected in the assessment of the quadrants by the lenders.
Okay. But since you looked at the numbers fairly closely, sir, would you say that we could see a lot of loans slipping into the red? Because, you have about 22 lakh crore or 42%, which were already weak and have gotten a little weaker because of COVID. That is your top right quadrant. And then you have another 15.5 lakh crores, which were also already weak before COVID hit. So do you think at the end of this exercise, we could end up with that, 13-14% of NPAs that RBI mentions in its financial stability report?
Let's put that in context. I think we believe there's a very large mass of assets which were in performing status, not more than 30 days overdue. To me, that is the big comfort in these numbers.
Okay.
Yes, the pressure that was there on industry pre-COVID, very little we can do about it.
Okay.
I think if it was in performing status on the cutoff date, I think that is where I think we have tried to see how can the banks and their borrowers take advantage of this step taken by Reserve Bank. This is a far-reaching step. I don't think as a banker I would have expected somebody to come up with a structure which is so facilitated. But I think it was done. And I would think that this is something that industry and banks should embrace and move along.
Okay. No, certainly. I mean, I have absolutely no complaint about that. The way in which the Reserve Bank has gone up, both the speed and the pragmatism, and similar objectives I would apply to your committee as well. But, there are some initial problems. The Reserve Bank rule says that if you can't agree with the restructuring package, the RP, there is a resolution plan, then banks can opt out by taking a 20% provisioning. Now, private sector banks have, in the last 6 months, accumulated enough capital from a rather giving market. Do you think that they may rather opt out than go through another pain of resolution?
Yeah, it all depends on, what constitutes the majority.
Okay.
And our trying to assume certain thing may not be fully right in this context. B, I would think every customer of every bank will have pain if they are in those quadrants. And I would think that a bank will have very little leeway to say that, I'm going to take a different, I'm going to sit at a different level and I'll make that extra provisioning and I'll get my money. The fact is, he may not be able to get that money from the client because the client may not have the wherewithal to pay. And very soon, a quarter or so down or 2 quarters down, this may be an NPA staring in the bank's face, that particular bank's face. So we will have these sort of complications. I'm sure bankers will take a very, I would say, considered view and come to a resolution which is equitable to themselves and to their clients.
Okay. All right. Now, there is, of course, even your committee will be vetting the resolution proposals for the large ones, 1,500 crore plus proposals. Now, Mr. Kamath, if we have to get to a debt servicing ratio of 1 or 1.2, that may not be obviously possible this year. You are expecting that by March 2022, the ratios should be reached. Likewise, for debt equity, you're expecting that it reaches 4 or 4.5 by 22, if not immediately. Now, all this will depend on what growth you are assuming. We just had Fitch saying that they're expecting India's GDP to be -10 this year. And they probably will say +5 next year, or I don't know their next year's number. It is possible that the rating agency will not agree to the growth assumptions. You don't see that as a problem?
Let us suffice to say that, I won't elaborate too much, but suffice to say, in this exercise, we have had the wisdom of both lenders, rating agency, and other participants.
Okay.
And after that, we reached numbers. We did not try to prescribe a number which we thought could be, could happen. So there was some, dialogue in coming to an assessment. And broadly, let me say this. Most people say, yes, this year is going to be a challenge. But most people, based on what challenge we have faced this year, expect the next year's numbers to have recovered. Next year meaning 21, 22. And I think it's based on that we have picked those numbers. One more thing. See, the whole exercise is a recast of the company's operations.
Yes.
It's a two-way process. The company and the bank sit together in the first instance with whatever advisors the company may have and recast the cash flow. And the banks will have to be skillful enough to recast it in such a way that when payments happen, and the Reserve Bank, again, I must compliment them, have given the banks enormous leeway.
Yes.
As long as your overall moratorium doesn't exceed 2 years, you have degrees of freedom how to design the repayment schedule within that context. And there it is where the ratios come in important, because you can always have a structure where your repayment is brought down for the years where the bank and the client senses pain and then goes up, so that you do not trigger a situation where you have a ratio which is under stress. That is why you cannot have a ratio below 1, because if there are payments, then you need to make sure that your interest and principal is serviced.
Yes.
So I think it has been done with that in mind, giving the bank and the client leeway to structure it appropriately. And the same goes with the debt equity ratio, that if you are constrained in your servicing ability, then additional capital has to be brought in and
Yes.
the ratio has to be corrected.
Yes.
If you are not, that is, your profitability comes back and you're generating cash at that level, then you have the freedom to structure it within the available accretion to net worth from your profit. So we're not second guessing what the client could do or the bank could do, but I think we're trying to give the leeway that in a, I would say, appropriately restructured case should be available to a bank and its client to come back to what I would call the new normal.
No, I agree with you, sir. In fact, a lot of bankers showered praise on you and the committee for actually defining the net worth correctly by deducting what the company may have invested out of its equity in subsidiaries and associate companies. So, you did get a lot of kudos for that. But what I'm only saying is that, a lot of people have to agree on the growth assumptions. The rating agency has to agree. All the consortium banks have to agree. Your committee has to agree. And there may be differing levels of optimism on India's V-shaped recovery. So I'm just wondering if a lot of cases could get stymied.
Again, I go back to the beginning here, Latha. What heartens me is the large, percentage of cases which are in this category, which, lend themselves to this restructuring. Whichever way we look at it, except the extreme cases where we will need probably innovative restructuring. By that I mean, probably a little bit complex, probably is the right word, complex restructuring, where you will have to do interest rescheduling,
Yes.
principal rescheduling, maybe some conversion is required.
Yes.
But all other cases, I think the companies come back to normal very quickly.
Oh.
But again, I can't second guess what will happen in the course of the next 2 years, because of we don't know exactly where this disease is going to take us and how quickly it is going to be addressed. All that banks and borrowers can do at this stage is try to correct the situation as is visible,
Yes.
and then proceed on that basis.
Yeah.
I'm sure, a key part here is, as you said, for the very large cases, you have the rating exercise also coming in. I think that gives the banks and indeed the borrower a comfort that what has been done is workable.
Okay. No, yes, I guess that is why the Reserve Bank wanted your committee to continue, so that you give that comfort to the bank's restructuring plans. They very much need it after the trying times that they've gone through. So, but I wanted to ask you about you said you can put the cases in 3 buckets: moderate, severe, and very severe. How much do you think is in the very severe category?
I think as speculative, in sense, I would put it as mild, moderate, and
yes. Severe
or severe stress. It would be right to say broadly that the top right-hand quadrant needs special attention.
Okay.
I don't want to say all of them would be in severe, because some of them are interesting. If you see the power sector, it's come back to its capacity very soon. There are other challenges which need to be addressed.
Yes.
So I think all of them won't be in the same category, and it's a lot of them will be codependent on something else, which is in some other sector.
Yeah.
So we will have clarity during the course of probably between now and March next year to get a fix on what exactly is going to happen.
Please hang on for a minute, sir. I have to take a break. We are coming back with lots more questions. Welcome back. We have been speaking with Mr. KV Kamath, the veteran banker who has just released the ratios by which banks have to adhere to when they restructure corporate loans. So I wanted to ask you another question, which is kind of the elephant in the room. The court hearing this case on waiving interest on interest. Now, the court has said one thing already, that moratorium cases should not be marked NPA. And the second thing that they are going to decide is that interest on interest may be regarded as penal. They have not yet pronounced on it. Do you think if they did one or both of these things, it might vitiate the atmosphere? I mean, after all, if banks are told that they can't charge interest on interest, what can they do? They have to charge higher interest to the next borrower, to the healthier borrower. Won't it stymie transmission? I mean, what kind of problems do you foresee?
Latha, again, this is a matter which is the Honorable Court is considering. So, to me, clearly it is sub judice. So,
of course,
it would be wrong on my part to comment on that subject.
Okay. No, I'm not asking you to say whether that would be right or wrong, but it could have a fallout. Would you worry about the fallout?
I would rather not comment on that.
Okay.
Honorable Court should give its...
Yes. No, fair enough. I'm not asking you to comment on what the court might say or whether it is right or wrong, but it's just that I'm only scared that it might have an impact on both depositors and borrowers, and even the healthier borrowers. Okay, separately, sir, do you think the government needs to pitch in? Because the corporate sector is going through a rather severe stress, do you think an interest subvention from the government, rather than make the depositors bear the can, or the good borrowers bear the can, would it make sense for the government to pitch in with either interest subvention or some payroll tax relief?
I think it's at this stage, again, what steps the government has taken have been far-reaching, the way I look at it. And I'm looking at it dispassionately. I think at this stage, when we looked at it, we did not see the need for a subvention on this front. Again, we will have to see the course of the disease and what happens next. At this point in time, things seem to be going on track to recovery. So I would think that any of these other instruments that we might need to look at probably are not called for at this point in time. We'll have to watch. Again, I want to reiterate that the course of recovery seems to be, as an observer, outside observer, better than what I would have thought just say 12 weeks back.
Okay.
And I would think that should provide us enough runway to get this economy back in flight path.
Without the kind of help that I'm suggesting.
Without the kind of help.
Okay. So again, going to go back to your quadrant, when you said 72%, did you include MSMEs when you said corporate sector?
No, this doesn't include MSMEs.
Okay. So now if you take the MSME segment, of course, they are getting a little more time for restructuring, and the restructuring was available even last year. There is also another piece now, retail loans, which the banks, of course, will decide on their own, but that's now a substantial part of bank exposures. And we hear from organizations like the CMIE that about 20 million salaried jobs have been lost in the last 6 months, and this does not even take into account the amount of pay cuts that the existing salaried jobs have suffered. If you take that into consideration, what is your estimate of the kind of pain the banks are suffering? Do you think we are going to look at what, 15-14%, the kind of stress that RBI spoke about?
Again, we have not assessed that, and having not assessed that, there are certain proxies we can look at in this. Indeed, the job losses were one.
Yes.
I would also look at the other number, which is the jobs in the unorganized sector, which CMI itself has said have come back. Now, if both were there, we would have had a serious problem. The fact that those other jobs are coming back, there would have been pain. There probably is continued residual pain. I think is good news. I think on the salaried class, if you look at the fact that corporates are expecting that in the next 1 or 2 quarters, they're back to about 90% of capacity utilization. A lot of these jobs would come back. As also, when we see migrant-heavy activities, construction, others coming back, I think these would come back. Now, I'm not very sure whether CMI counted that or not, but I would dare say that once the economy comes back, the pain goes down from 24% drop in GDP to over the next 3 quarters dropping pain. These jobs should be coming back. So as a banker, I would think that indeed there will be pain in the retail sector. I don't want to fix on the number that the Reserve Bank has put in. If probably that number is right, or it could be better. Given the recovery, I do not think it could be worse. The reason is that when the numbers were done, this was probably done in April, in May or so.
Yes.
Before it was forecast.
That's right.
I would think that 2 months is a long period in this the course of this disease.
Okay.
I've had to revise what I'm learning.
Okay.
I'm not that I'm speaking about it, but what I'm learning virtually every 2 weeks. So in the last 4 weeks or 8 weeks, 6 weeks, things have improved. So this number should hold. It could be the worst case scenario. When we should look out for a better number.
No, you are the original retail banker, actually. I mean, the way you steered ICICI from a development financial institution into a lot of retail lending. And that's why I wanted your view. This is the first really painful retail cycle we are seeing in terms of salaried jobs. So you don't think it could be that painful?
Yeah, it should not be. And again, the leeway that the Reserve Bank has given is enormous.
Okay.
I think within this, a banker should be able to meet most of his challenges and most of the challenges of his clients.
Okay. Well, since I spoke about development finance, let me just get that one comment from you. The government, we understand, is contemplating setting up another development finance institution because once again, there is a problem of finding money for infrastructure. You have been there, done that. You have seen all the experiments in India from IDBI, ICICI, IFCI, IIFCL, IDFC. I mean, the entire range you have seen, including PFC and NABARD and NHB as well. What would your advice be? Another DFI is needed for infrastructure financing?
I'll capture it in 2 sentences or 3 sentences. If you look at the history of DFIs in the 50s, they were set up because there was absolutely no financing available for industry. in the 90s, we had to course correct because there was absolutely no funding available for a DFI. So they should turn. Now, why was there no funding available? Because till then, we were able to issue government guaranteed bonds in the market, which was giving us the funding base, as it were.
Yes.
All three of the institutions that were there. The 90s, that was withdrawn. So for force, we had to then convert ourselves to a new structure where you could get access to money. Therein lies your answer. I think clearly, yes, there is a need for long-term lending type of institutions, or the market itself is able to provide long-dated instruments to these companies, whether new or existing. The problem is, where will this sort of a structure get access to long-term funding, the institution? If that can be resolved, then I think it is workable. So if you take the case of the BRICS Bank or the New Development Bank, we were clear that if we got a high enough rating, we could go out into the market and get the money, given a strong capital base.
Yes.
So let's assume that this new institution has a strong capital base. I think what we need to make sure that its access to funding is well understood and well defined, so that it can continue to do it. It can perform the role that you are you want it to perform.
It is my expectation, my sense that the government will pick your brains on this, because I understand that some plans are afoot to encourage infrastructure financing. But thank you very much for all the extra light that you have shed on the Kamath Committee recommendations. It is important that KV Kamath thinks that not too much will go bad, and that he sees a lot of recovery. He's gone through the numbers, in great detail, and therefore one hopes that at the end of the implementation of these resolution plans under the Kamath recommendations, the corporate sector will come out looking much better. We have to take a break on that note. There's lots more lined up for you.